Hi, I'm Ben Lilliston, and I'm with the Institute for Agriculture and Trade Policy. We've written a series of papers leading up to the Copenhagen climate meeting in December, and one of them has to do with carbon markets, and more specifically carbon derivatives, and the potential that that could have to unsettle both carbon markets and agriculture markets. And the author here is Steve Supan, who has written this paper, and last year had written a paper on agriculture speculation in agriculture markets. Steve, maybe you could just kind of tell us a little bit about exactly what is a carbon derivative and how would this fit within what's being talked about as a new carbon market?
Well, there's a fair amount of misunderstanding about what a carbon emissions market is and the difference between that market and a carbon derivatives market. Carbon emissions trading, as it's practiced now, largely concerns trade between those industrial facilities that receive carbon allowance credits from governments, and they're allowed to trade these or carbon offset credits to try to meet their commitments to reduce greenhouse gases. With the derivatives market, they take the value of those carbon allowance credits given freely by the governments to what we used to call major polluters. And they take the offset credits and they make financial products out of them. And while there is a physical limit to the number of carbon credits that are given, they're 1 metric ton units created by the government, the number of derivatives contracts is theoretically infinite. And so it's a very different market. It's a market that the financial services industry predicts will be $2 trillion by 2017. So it's a much, much larger market than the current trading in what's called the primary market for carbon emissions trading, which is in the neighborhood of $30 billion worldwide.
Who really wants this carbon derivatives market? Who's pushing for it and who stands to benefit?
Well, it's a very peculiar division. I mean, obviously the financial services industry wants it, but there are also some energy companies that make more money by trading energy's futures contracts, such as the Shell company. They want an unrestricted carbon derivatives market because they have the inside information to benefit by it. There's a huge or very large price correlation between carbon prices and energy prices, especially oil prices. So they have the information from which to benefit by it. In addition, at least the U.S. legislation allows financial services institutions to own the carbon allowance credits and the offset credits themselves, and so they also have a lot of inside information and actual control over the primary price from which the derivatives price will then be created.
What are some of your concerns about how this type of market could affect agriculture and it could affect our ability to reach greenhouse gas emission goals?
Well, these, on the face of it, you would say, it must be a very indirect relation. But under the terms of the U.S. legislation, the carbon derivatives will be able to be bundled in what are called commodity index funds. And the performance of commodity index funds from 2006 to 2008 created huge price volatility because the index speculators were not subject to the position limits, the number of futures contracts that somebody that actually uses commodity is subject to. So they had a huge weight of money which could create huge price volatility in agricultural and non-agricultural commodities. Now, if you throw carbon into that mix, so for example, right now, oil futures contracts comprise between 30 and 40% of the commodity index fund, but let's say, in agriculture, only 20%. But let's say that carbon then occupies 20% of that fund formula and agriculture shrinks. Well, the least dominant player in the fund is going to be the most affected. But so there could be, again, this terrifying price volatility that will make it very, very difficult for import-dependent developing countries to use the futures markets to manage their price risks. And right now, prices for them for basic food crops continue to be very high. The other aspect of this, which is not so well researched or understood, is that by creating extreme price volatility in the carbon market, which is what's happened in the European Union emissions trading scheme, investors who are looking to price signals from that market to decide when and how much to invest simply are going to have a very difficult time doing it, because the price of carbon is one of the major factors in how they calculate their rate of return on investment. If the price is all over the place, then it's not going to be possible for them to calculate this rate of return with any confidence. And the likely result, and what has happened in the European Union, is that major power plant operators, major users of electricity and oil, such as cement companies, simply have not invested in greenhouse gas reducing technologies.
Steve, do we need a carbon derivatives market? Is it even necessary? And if so, how can we regulate it to measure some of this volatility?
Well, the argument of the financial services industry is that without carbon derivatives, there won't be enough capital in the primary market in order to facilitate trades, or as they say, clear trades. But that is a really an unproven assumption. But the other possibility that has not really been considered is that since the purpose of this trading is not to find the right price in carbon, but to actually reduce greenhouse gases, since there's a very specific legal purpose, the government has every interest in being able to supply some of that liquidity in the event that the private traders cannot. So I think that's one issue. It's not at all certain that a primary carbon market is going to work, especially because of the difficulty of verifying that the offset projects actually reduce greenhouse gases. But if you inject the huge volume of capital of carbon derivatives into the market, it is almost certain that the market will blow up. There'll be a huge asset price bubble, it will blow up, and it will delay investments in greenhouse gas reducing technologies, and hopefully, if that happens, the blow up will occur sooner rather than later, so that we are not too late in the race to prevent these unpredictable positive feedback loops of climate change, where the kind of very severe effects of climate change are most likely to occur.
Thanks very much.